here's that form down here at the bottom of the form here. It does say, talk about what kind of coverage have you offered, did you offer it, what's the cost, what's the premium contribution, that sort of thing.
That's going to be a different number for every employee.
Potentially, if that's the way it's set up, potentially it could be a very much an individualized form for each employee.
New employee at day 90, you look at the first 90 days and what they make.
Well,
9.5%.
Well, we're getting to that. We'll talk about the affordability test and for large employers, exactly what those tests are in just a second. But before I go on to large employers, those 50 or more full-time equivalents, do any smaller employers have any questions? Okay, we'll move on then. The large employer requirements and most importantly, the employer mandate. The employer mandate says applicable large employers, those with 50 or more full-time equivalent employees in a given year, must offer their full-time employees and their dependents that minimum essential coverage or face potential penalties. So we talked about what applicable large employers are. We'll walk through what an offer of coverage is, who your full-time employees are, and we've kind of talked about that. That's 30 hours a week or 130 hours of service in a calendar month, and their dependents and what exactly that means. What minimum essential coverage is for the employer in this large group, large employer section, and I'll walk through the penalties as well, and we'll get into the affordability test and some of the other things in that discussion. So what does it mean to offer coverage? It means that you give the employees an opportunity to accept or decline your coverage. It does not mean, as actually is pretty common in this industry, especially for management, that you're paying 100% of the premium. That's not what it means. It means they can accept or decline. And that is your obligation, is to offer, make it available. There were a lot of questions in the industry about what happens if an employee doesn't have enough in their paycheck to cover the deduction from their payroll, their paycheck, for the premiums. And would that mean if they didn't have anything in their paycheck to do that, does that mean, what can the employer do? And does that mean that if they do drop from the coverage, is the employer subject to a penalty because of it for not offering? Well, this was clarified, and a lot of this was clarified in a January 2nd Federal Register proposed rule from the Treasury Department. And what that means is just, we have the rules by which you can start planning and implementing this within your businesses and complying. And what they said is that employee non-payment of premium does not constitute a non-offer of coverage. So if you have an employee who their hours drop, or maybe a tipped employee whose tips are paid that night, cash, then you must give them an opportunity under the COBRA rules of 30 days to reimburse you for that premium, for their premium contribution that was not taken out of their paycheck, they couldn't cover. And if they don't, if they don't take that opportunity and pay that, you can take them off your plan, and it does not trigger a penalty. It is allowed. Now that employee can, if they're eligible, re-enroll at your next open enrollment date, or if they get married, or if they get divorced and there's a special event that they can then enroll, they can certainly do that again, and you might start this whole process over again. But it does not mean that you're faced with penalties because somebody didn't pay their portion of premium, nor does it mean that you have to pay and pick up the rest of the 100% of the premium. There's also a recognition from Treasury that offer of coverage doesn't necessarily mean that you're offering to 100% of people. They recognize that mergers happen and maybe one entity or one subsidiary of a company isn't doing things exactly the same way as everybody else is and has been doing. Maybe you get it wrong. They've allowed for a 5% margin of error here, or for smaller employers, the greater of 5 or 5%. And so if you do miss 5% though, those 5% may trigger a penalty for you just on those people. It won't trigger a penalty on everybody that you didn't offer coverage. So they've allowed a margin of error here. It is only 5%, but it's not 100% perfect all the time. Standard. Okay, full-time employees and dependents, who you're offering coverage to. Full-time employees, as I said, 130 hours a calendar month. And you're offering to dependents. And we needed a definition of who a dependent was, because there's lots of definitions in tax code all over the place about who a dependent is. And what Treasury has said, they've defined it very narrowly, that a dependent is a child of your full-time employees up to age 26, so up to their 26th birthday. You will rely on your employees' designation of who their children are and their ages to know who those dependents are. And what does it mean to offer coverage to dependents? Well, it doesn't mean that an employer has to pay actually any of the dependent coverage. There is an affordability test, but it's based on self-only coverage, so it's only based on coverage for the full-time employee. You can ask your employee and their dependents to pay 100% of the dependent portion of the coverage, but you are required to offer dependent coverage, make it available. Treasury has said that if you're having difficulty doing so, finding dependent coverage to offer, they have given us transition for 2014, but by 2015 we do need to be offering fully dependent coverage. And there's some caveats to that and rules, but you basically have to be taking steps to get dependent coverage and make it available. Important note, an employee's spouse is not a dependent. As I said, it's the children up to age 26, and so that's much different. The reason being, it is splitting households, but in some cases they wanted the spouse to be able to go to the exchange to get a tax credit and be able to get a subsidy, whereas if they were offered it by their spouse's employer, they wouldn't be able to do so if it was affordable. So let's walk through the penalties, because that kind of gets to minimum essential coverage and what you're required to offer. Who triggers an employer penalty? It's the use of a federal subsidy called a premium tax credit or a cost sharing reduction by a full-time employee to purchase coverage on the exchange. And those full-time employees are only between 100 and 400% of federal poverty levels. So somebody above 400%, even if you don't offer them coverage, if all your employees are above 400%, say you're a law firm or accounting firm or something like that, you're well above that, they're not going to trigger a penalty for you. 100% of federal poverty level for 2013 is $11,490 for a single individual and $23,550 for a family of 4. So that's 100%. So again, everybody below that you're not necessarily worried about, but those are also folks below that here in South Carolina, because you're not expanding Medicaid in certain categories could be part of Medicaid. In states that do expand Medicaid, it's everybody up to 138%. So that's why 138% is on this chart, but here in the state, that doesn't apply. And so 400% is $45,960 for a single individual, or $94,200 for a family of 4. So you can see the wide band of folks, anywhere between $11,490 and $45,960, that could trigger a penalty for you. So those are the folks that, if they go to the exchange and obtain a federal subsidy, are eligible for it, they could trigger that penalty, the full-time employees. And what are the penalties? I've got a bunch of numbers and sections of the tax code listed up here. It's called 4980H of the tax code. That's just the section that it is. There's two parts. There's A and B. The A penalty is the $2,000 penalty, and the B penalty is the $3,000 penalty. So the A penalty is if an employer does not offer minimum essential coverage. Say I'm out, or your coverage doesn't qualify, whatever you're offering isn't minimum essential coverage. And the B penalty is if you are offering, but maybe you didn't get the affordability right, or you didn't get the minimum value right. There's two tests in that. Or maybe you missed that 5%, one of those employees that one of the subsidiaries didn't get right. If those go to the exchange, it would be this B penalty, the $3,000 penalty. So let's walk through each of these in turn. The A penalty, again, for not offering minimum essential coverage. Minimum essential coverage hasn't been fully defined under this penalty. There's a question and a lot of discussion in the industry about defined contributions. And so Treasury needs to answer, does a defined contribution actually satisfy the A penalty or not? So we should have some more rules coming on that. But essentially, if you're out of the game, you're not offering anything, it's the A penalty, and you're a large employer. It is $2,000 per full-time employee, minus the first 30. This is the 30 discount. These penalties are going to be looked at on a monthly basis. And the way we think they'll be assessed is actually on an annual basis at the end of the process. It actually might be a year and a half before the start of 2014 before you're paying the penalty. January 2014 to probably sometime after April 2015 before you get the tax assessment. These are indexed, both the $2,000 and the $3,000 penalty are indexed after the first year, and so they will go up. But monthly, it's $167 a full-time employee, per full-time employee. Okay, the 30 discount on the first 30 employees. I have another example here, and this is where the applicable large employer member and the entities become important, because the penalties are not assessed on a control group basis, they're assessed on an individual member basis. So in my example here, I have an employer with 105 full-time employees, and you can see the parent S Corp has 15 full-time employees, another 2 LLCs have 10 each, another one has 15, 25, and 30 in each of the entities. Now, they've written rules that say, you can't just say, oh, this entity over here has 30 full-time employees, so I'm just going to take all of 30 off of there, and they don't have to pay a penalty, and then everything else, we'll worry about that. The 30 has to be applied proportionally based on the number of full-time employees you have, each entity has. So this took some a little quick calculation here, but so total 105, had to figure out what 15 was in terms of percentage of that. So I figured out that 4 of the 30 are taken off this first one, so that this entity, if they weren't offering coverage, the A penalty, they'd be paying the penalty on 11 full-time employees. This one over here has 10, we took 3 off of that, that's 7. So you can see it's all based on how many full-time employees you have, and you have to figure it out based on how many entities and how many full-time employees you have in each entity proportionally.
Is that 105 based on our equation or actually people that are full-time employees?
Yeah, I use actual full-time employees, 105. So this penalty is only on full-time employees, not equivalents. The only time you use part-time hours and equivalents come into play is in that calculation. Are you above or below 50? So the penalties are only on the actual full-time employee working 130 hours or more in a calendar month.
So it's based on, I am a large employer, but how many hours I'm working. If I got to this, 'cause I have 3 restaurants. In those 3 restaurants, I had 25 full-time employees. I would need them.
Yeah. So somebody who has less than 30 full-time employees, truly 30 full-time employees between all their businesses within the control group, and you'll apply that 30 proportionally. You've got less than 30 full-time, so you don't have a penalty for not offering coverage. You get to that 31st employee, and then you're paying $2,000 times 1. $2,000 times 2 if you've got 32. So, yeah. They've added in kind of this gray area, I guess, above that. So that kind of fades in the penalty, so to speak. Okay, the B penalty. This is the $3,000 penalty, $250 a month per full-time employee. But this is not based on all full-time employees. This is based on only employees for whom it was unaffordable, or the plan didn't meet minimum value, or it was one of those 5%. So it's only for those individuals that went to the exchange for whom that applied. If you offered a plan that wasn't affordable to anybody, but none of your employees, full-time employees, went to the exchange and got a subsidy, you wouldn't get a penalty, because it's them obtaining the subsidy that triggers the penalty. Again, indexed for inflation, and there are 2 tests in here. Again, the minimum value and the affordability test. Next slide, I'll talk about those. But important to know, they did limit the maximum of this B penalty based on the A penalty. So basically they said, we don't want somebody who's offering coverage to be penalized more than somebody who is. So they've maxed the A penalty. Minimum value under the law, it says a plan must cover at least 60% of the total allowed cost of benefits provided by the plan. It's a lot of confusing words. It has essentially been interpreted to mean actuarial value, which is an insurance industry term, and it measures the value of the benefits of the plans that they use to compare plans, basically. Those metal plans within the exchanges, those were actuarial values. But basically, you could have 2 plans that are at 60%, but because this employer has, say, it's an automotive shop, it has a lot of older male workforce, that maybe there's some special cardiac care designed into the plan, and this employer, the affordability test. Affordability refers to, is it affordable to the employee? This law does not speak to the affordability for the employer, and that's something that we've talked about quite a lot, because that's not addressed here. So when we talk affordability in this test for large employers, we're thinking about the employee, and it is based on single-only coverage. So is just the coverage for the employee affordable, not the dependent coverage, just the employee. And for it to be affordable to the employee, they cannot be asked to pay more than 9.5% of their household income as a contribution to the premium. Household income is not something you will know. It is what they file on their tax returns, their modified adjusted gross income, or they aggregated modified adjusted gross income. And so Treasury recognized that you need predictability and certainty to be able to say, okay, I know that my plan isn't going to violate this test because I'm trying to make sure I'm trying to offer coverage, I'm trying to hit the sweet spot here and not get a penalty. So we were able to convince them to give us some safe harbors, and actually they gave us 3. The W-2 safe harbor, the rate of pay safe harbor, and a federal poverty level. So you're a large employer, you figured out you're going to offer coverage, you know what the penalties are, you know what kind of coverage you have to offer, what the make it affordable to your employees. Who do you have to offer it to? Right? Let me get through this and I'll take your question. Full-time employees and their dependents are who you have to offer it to. And so For some, you're going to know that your employees are full-time, your general managers, your assistant general managers, whoever those are, maybe, right? And you're going to have probably a whole bunch of part-time employees potentially that you might know. And one strategy could be that you could keep full-time, full-time, and keep part-time, part-time. And that could be a strategy. But we also know that there are a lot of folks in the industry who have variable hours and whose schedules are very unpredictable, and it's very hard to determine, right, is this a full-time employee under the law or a part-time employee under the law? And so we worked with the Treasury Department to develop a method so that you didn't have to determine month by month by month who's full-time, who's part-time, who's full-time, who's part-time. Because that would cause a full-time employee, somebody who's, say, in January, a full-time employee, they've got your coverage, you've got them enrolled, okay, good. But then February, they're not. Well, because their hours dropped, they went to the exchange, they qualified for a federal subsidy, they got coverage through the exchange, but then January, they're full-time again, and they're having to start a new plan every single time, new deductibles, new everything, co-insurance and all that. They knew that employers and even the IRS couldn't track this on a month-to-month basis. And so they said, for employees for whom their hours vary, and it's very unpredictable, we need a way to be able to determine are they full-time or part-time, so you all know who do I have to offer coverage to, what's my obligation, right? And so they developed this optional look-back method. This is optional, this is not something you have to do. So again, you could keep full-time and part-time in those categories, but for others, if you choose to, there is this other method. And I will admit, it's not easy, and it's not simple, and it's way more complicated than it needed to be. And it was going to be way worse, too. We stopped some things that they would have new one rule for new hires, a different rule for current employees. It would have been even more of a mess. But it is an option for you. And again, here's who it applies to: the variable hour and the seasonal employees. And it's based on variable hour employees based on a facts and circumstances test at the start date. Can you reasonably expect that you don't know, are they going to work 30 hours a week or not? If you know, then they're full-time. If you honestly don't know, then they could be in this category. There are, for employers that are subject to the employer mandate, there are reporting requirements. The IRS needs to figure out, did you as the employer offer coverage to your full-time employees as you were supposed to under the law? Did they take the coverage? Compare it to the individual's income tax return that declares they got coverage from their employer or they got a subsidy or what have you. That'll be on the 1040. And also look at what the exchange did. Did the exchange give them the subsidy and that sort of thing? So the IRS is the final arbiter of all of this. And they are the ones that, once you get through all of this reporting and everything, and you get a tax bill from them, there will be an appeals process. As I mentioned earlier, the exchanges will send you notices that your employees went to the exchange. It's the IRS at the end of the day that will be doing the assessments. Should you have the penalty, or is it the employee that should not have received that subsidy, and so they're going to claw that back? So it's the IRS that does all this. And it's based on this reporting. This reporting begins January 31st of 2015, and it's reporting in plan information and information on individual employees and their dependents. Who took your coverage, who didn't, what was the maximum waiting period that you allowed, that sort of thing. It's under 6056 of the tax code section. And again, applicable large employers certifying to the IRS that you offered minimum essential coverage. Name, date, employer ID, certification of minimum essential coverage. As I said, number of full-time employees in each month, name, address, tax ID number of each full-time employee in the months, and they and their dependents are covered by the health plan. And then you must also, what you provide to the IRS must also be provided to the individual employee as well. So this is, as well as contact information for who's responsible for doing all of this. So your employee is going to be getting a communication from you each January 31st or soon thereafter, right? For those who are fully insured, so again, the insurance company is paying the medical claims, your health insurance company will be filing a similar, slightly, very duplicative really, report. For self-funded employers, the employer will be filing a second report. And this includes, again, name, address, tax ID of all those insured and covered under the policy, dates of coverage in the calendar year. Did they have it January through June, but not July through December? Whether it was a qualified health plan purchased on the exchange, if you're a smaller employer and that's an option for you. Name, address, employer ID, portion of the premium paid by the employer, and again, providing the same report to the individual employee as well. So lots of detail here